trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Welcome to all of our options traders, market rebels out there in YouTube land. And Stu, we have another very cool Coach's Corner for people today.
This is a very cool Coach's Corner. Very cool.
It is. I think it's going to help people a lot. We want to show you it's really just a matter of perspective, but it goes a long way into helping you understand strategies, how they're going to form over time and why. But first, let's start off with a little chalk talk question like we always do. This is our thought-provoking question. For anybody who might be new, we're going to come back at the end and answer it. But does a call option gain dollar for dollar as the stock rises?
So, Bill, is this a trick question?
I was going to say, before you jump on your answer, Stu and I never ask anything that's really obvious. And I think most people are going to go, well, that's stupid. It's obvious. It's not so obvious. But we want you to think about, it's a little hint, so we want you to think about that question a little bit more before you answer. Okay, so we're going to come back and answer that at the beginning. So our topic is, as you've probably guessed, does an option move dollar for dollar with the stock?
What happened to Ben Franklin? How come he's not on it?
I know, he kind of vanished on there, but it gave me a nice little blank spot for my title.
Okay.
And the thing is, I think if you ask most people, I think it's safe to say they would say no. A call option does not move dollar for dollar unless it's extremely deep in the money or maybe close to expiration, a little bit in the money, but no time would also push it to delta 1. And that's what how most people would answer, that it doesn't move dollar for dollar. Well, it really depends. Again, it's a perspective thing. Is the glass half full or half empty? So we're going to kind of take a look at what's going on here when we say that an option doesn't move dollar for dollar. So this whole concept of an option's value changing with the stock or how it changes relative to the stock is shown by delta. And I think most of you out there know that. Delta is one of our many Greeks that we have on our broker's platform, and it shows the sensitivity of an option's price in relation to the stock's price. So if we have, let's say, a stock at 103 and we have the $100 call trading for 5, you might look on your broker's platform and see a delta of 0.70.
Sounds about right.
Yeah, probably about right. As a reference point, the at the monies will generally be a delta 50. So this is in the money a little bit. Now, if we had a long time to expiration, delta might be only a touch above 50. But at any rate, there's a number of interpretations. Some people will say that it's behaving like 70 shares of stock. The contract controls 100 shares, but right now it's behaving like 70. And if it stays in the money as time goes by and or as the stock continues to rise, this will start pushing towards delta 100. Now, another interpretation is to think of it as the percentage that that you're capturing. Whatever that stock price move is, you're capturing 70% of it. But it's only for that next move. Sometimes that's a big mistake, isn't it, Stu? We hear from traders that go, stock goes up 8 points, so I'm going to pick up 70% of that. No, it's only for that next tiny move. So if it moves 10 cents, you would expect the option to move 7 cents. If it moves $1, if the stock moves $1, you would expect the option to pick up 70% of that, or 70 cents.
Yeah, and you can get a little crazy with this. I mean, it's actually infinite iterations as the stock is moving
Oh,
up.
yeah.
We just define the delta as per dollar move.
Right.
It's always moving.
It is always moving. Yep. So let's say that the stock rises $1 to 104. Now, again, quick little footnote here. Remember, this is an instantaneous change. Sometimes traders will put this on. They'll say, if stock rises $1, I'm going to pick up 70 cents. And then 3 weeks later, it rises $1. And they go, how come my option didn't pick up 70 cents? Well, because time has passed. This is talking about right now, $1 move.
Yeah.
So if that happens, we should pick up about 70% of that move. 70% of $1 is 70 cents. So the option is currently trading for 5. So we would kind of project or anticipate that it should be trading for 5.70. So the point to see here is that the stock increased a full dollar, but the option increased 70% of that, or 70 cents. And this is why options traders say, see, an option doesn't move dollar for dollar with the stock. It only moved.
Which is true.
Again, it depends on how you look at it, which is what we're going to talk. Yes, you could certainly make an argument it didn't rise dollar for dollar. Because sometimes people say, that's kind of weird. Why would the stock rise $1, but my option doesn't? Because my option gives me the right to buy the stock. Shouldn't it behave just like stock? Well, that would actually be too good to be true. If you could buy $100, the stock here is trading for 103, and you could buy it for $5. What's wrong? That would be an instant arbitrage, right? It cannot be exactly shares of stock. There has to be something. Part of that something, as we'll explore later, is the right to walk away. We have an insurance policy here, and that's part of what's causing this option to not move dollar for dollar. So let's go look at a risk graph. Here's our option at 5. There's our maximum loss. We get our bend. Everybody knows this by now. At 100, that's our strike. So the black line is the expiration graph. We only look at that final seconds before the expiration bell on expiration day, not just the expiration or the closing of the market, expiration of the option. That's the only time that black line applies. Prior to expiration, you're going to have what's called the current curve, and right now that's the red curve. And as time goes by, that red curve slowly starts to sink towards the black. But the point to see is that delta, another interpretation for all of the math people out there, is that it's simply the slope of this red line at these various stock prices. So let's say that if the stock is down here somewhere near 85, you might look on your broker's platform and see that it has a delta of 10. That's because you've got the right to pay 100. The stock's at 85. Who wants that?
Not really doing me much good, is it?
Not doing me much good. So the market's not going to, let's say, reward you as heavily just because the stock went up $1. So you might see a delta of 10, but if the stock is up here, maybe, you might look and find out that your delta has increased to 30.
Might be worth a little more.
That's right. Stock goes up into here at the money. As I said before, the delta will be somewhere around a half. 50 is going to behave like 50 shares of stock. But only when we start getting way up here, we're going to start pushing certainly above 50 and getting closer to 100. So we might see a delta of 70 here. That's what we saw in the example. And then maybe if the stock is way up here, close to 115, we might have a delta of 90. And the only time we're going to hit delta 100 is under two conditions. With the stock up here at 115, either the red line has to sink to the black, which means time has passed, we're at expiration, or we continue to march higher. Because you can see that if the red line falls to the black, that's shares of stock, that's delta 1. Or if the stock continues higher, this red line will eventually be parallel to the black. in which case it's delta 1. But right now, we're neither of those. Okay, so Stu, let's talk a little bit. Why is this delta 1 here on this black line, the expiration curve?
That's your stock. Oh, that's your option. That's your why. So what's the question? Why is it what?
Why is this delta 1 right here on this black line above 100 for the expiration graph?
So I think where you're going is there's no extrinsic value left, and it's a delta 1 option, and it's just acting, behaving, smelling, thinking like stock.
Yep. And exactly right. What I was looking at too is that the other thing is that this option is going to get exercised because we're at expiration. It's in the money. Doesn't mean it has to be you, but somebody's going to exercise that. And so if you exercise it into shares of stock, you have delta 1. Right? So if the stock is below the strike, you're not going to exercise that. You've got no shares. You've got delta 0, and you've hit your maximum loss.
This is really it's very intuitive if you just kind of think it through. The contract represents your ability to take delivery. We call it take delivery to get 100 shares of stock. That's generally right. Most of the 99% of the time it's going to be 100 shares, unless otherwise stated it's going to be 100 shares. So if you could take 100 shares, then you can take 100 shares. It's not 90 shares. It's not 80 shares. It's 100 shares. So it's like, think of any asset. It could be a stock, could be anything. Right? If you can get 100 shares of stock at, whatever price, 100, not 95, say, then your right to pay 90 has to be valued at $5. Right? It has to. You're paying $5 underwater.
Yeah.
So you're getting a benefit, and is this where you're going with this, Bill? That's going to be your intrinsic value?
Yeah. And also, we're going to talk about that in a little bit. Yeah, it was basically just to show that
the other side can go to 0.
Right. It's just to show that somebody is going to exercise this into shares of stock. So if the very best you can get out of a call option is 100 shares of stock, why would you expect the delta at some point to be 101 or 110? That would be just way too good to be true. The very best it can be is 100. So the point was that this line, this black line, is delta 1. It's exactly what would look like long shares of stock if we graphed it. It's just that they would continue down this way. So you can see that it's not quite parallel to that black line. Black line's a little bit steeper because delta 100 is bigger than delta 90, but we're getting there. Okay, so now that's kind of an overview of our deltas. So let's go back to our example here. We have stock at 103, $100 call trading at 5. All options can be broken down into intrinsic and extrinsic value. Sometimes there's going to be no intrinsic, maybe no extrinsic, but we can still break them into 2 parts. So in this case, we have the right to pay 100 for stock that's trading at 103. So what does everybody think the intrinsic value is? What's the bare minimum that call would have to trade for?
So again, get back to that definition, or just get back to basics. The right to pay 100, right?
Yep.
That's the strike for an asset or a commodity, whatever you want to call it, which is being valued in the real world at 103. Hey, right. I can pay 100 for that basketball, but it's trading next door at 103. It's got to be $3.
There's a benefit. Right. There's what's called an arbitrage if that's not trading for at least 3. So that's what's called the intrinsic value. Sometimes we call it the meltdown value. So if you think of a rare coin, might have $1,000 worth of gold, but the coin might be worth $10,000. That's the extrinsic value. But if we melt it down, we could get the $1,000 of gold out of it. That's what's happening here. You could always exercise this call, get stock worth 103, sell the shares, and pick up $3. So we know it's got to trade for 3. We know minimum. So there's $3 of intrinsic value. However, it's trading for more than 3.
Now, see, the $5 is the real world.
That's where it's trading. We know it's got to trade for at least 3, and it is. But how do we account for the other $2 here? Extrinsic value or time value. And the reason for that is that somebody, if they want to buy this option from you, obviously has to pay the $3 of intrinsic. But because there's time remaining, in this example, they're willing to pay you another $2. Now, this is entirely up to the market. This $3 isn't. There's an arbitrage. We know for a fact it's got to trade for at least 3. But that's assuming the stock doesn't fall. But right now, with the stock at 103, it's got to be worth at least 3. The $2, pricing model might tell you it's worth $1.50, and it might be trading for 2, or it might be trading for 75 cents. So this is entirely up to the market. What are people willing to pay over and above the intrinsic value for this option? So right now we made it $2. So the other thing to notice here is that if we add the intrinsic plus the extrinsic, what do we get? We get the option's total price. So that's why we said that all options can be broken down into intrinsic and extrinsic, especially if you keep in mind that one of these numbers might be 0. Or they might both be 0, but we can still break them down into 2 parts. All right, so that's going to be important for understanding where we're going with this. And before we do, quick reminder, marketrebellion.com/get started. We have a tremendous amount. I was actually just kind of browsing around through there. There's a lot of good stuff on there, Stu. I got some very good articles and videos and things to help people get started. Lots of content just like this. So check it out. It's really important that you get a good foundation if you are serious about trading options. So let's talk a little bit about the intrinsic value. Okay, the intrinsic value always will move dollar for dollar with the stock. But the extrinsic value subtracts from it. And this is something that people just kind of miss. And the point is that if the option is always moving dollar for dollar with intrinsic, because it has to, and we know the extrinsic value subtracts from it, it makes it appear that the option isn't moving dollar for dollar. So again, is it? Well, yeah, you could say that it didn't move in total dollar for dollar, but then you could also say, well, wait a minute, it did move dollar for dollar. It's just that the extrinsic value dropped. So again, is the glass half full or half empty? Again, it's a little bit of almost a play on words, but it's an interesting perspective. So what we want to explore now is, well, what makes the extrinsic value change? Why does the extrinsic value drop? Why is that making our option lose some money there? Well, let's go back to a pricing model here. We're going to look at several stock prices starting at 101 up to 103. And the pricing model says, under certain volatilities and time to expiration, the 100 call, let's say, is trading for 3. And because the stock is 100, it's all extrinsic value. So how much intrinsic value is there?
It's not in the money, so there's no intrinsic value.
No intrinsic value.
Very easy, right? It's at the money.
So now let's put the stock up to 101, everything else constant, keeping time the same. What happens to our options price according to the pricing model? It says it's worth $3.55. Now we can see our 50 delta coming into play. We picked up roughly 50% of that $1 change. But what did we pick up over here?
The big G.
How much intrinsic value did we gained? A full $1 of intrinsic.
Right.
So if the option is worth $3.55 total, and we picked up $1 of intrinsic, what happened to our extrinsic?
Lights out.
$2.55. See, so we have to say, well, why did the extrinsic value drop? Because we're not even assuming that time has passed. We're just clicking away in a pricing model. We're going to find out more about this, but why did the extrinsic value drop?
And by the way, a little sidebar there, that 55 cents, that extra nickel off of the 50 delta, that's your gamma, everyone.
That is from your gamma. Absolutely. So let's try it again. Stock goes to 102. Option pricing model says it's worth $4.14. We have $2 of intrinsic value. $100 call, stock's at 102. We know it's got to have $2 of intrinsic value.
What's left over?
What's left over? $2.14.
14. So what's going on? Watch the pattern here, everyone.
Okay, let's try one more. Stock goes to 103. Pricing model says it's worth $4.78. Intrinsic value is how much, Stu? $100 call, stock at 103 is?
Hold on, I got it.
I got my fingers. $3.
$3.
But the option's $4.78. So what's not being accounted for here? $1.78 of extrinsic.
$1.78. So See how quickly we're able to do this? Like it's not like, oh, what's the strike or what's it? All that is
Yeah.
remaining constant. We're talking about one specific option. It's the 100 strike, and all we're doing is changing the price of the option of the stock.
Of the stock.
Right now, think about what you can do with that. Well, let's see. I have a stock that's 79, and I'm looking at my chart. There's this resistance up at 85, and I kind of think it might be going there, so I'm going to be bullish, and I think it might happen in a week or a month or whatever. What's my option going to look like? Oh, here, I can kind of figure it out. Right? And that'll give you an idea of what you're looking at down the road before it even happens.
Absolutely.
Yeah.
Yep. So take a look at what's going on here. When the stock goes from 100 to 101, that's a $1 rise. What happened to our intrinsic value? Whoa, look at that, Stu. It also increased $1. What happened when the stock went from 101 to 102? That's a $1 increase. Look what happened to our intrinsic. Also went up dollar for dollar.
Yeah.
Stock goes from 102 to 103. What happened?
So it kind of looks like it's going up dollar for dollar.
Well, it is. Again, it's a perspective thing. It is going up dollar for dollar.
It's only a piece of the price of it. So you got
exactly. So where is it what's being subtracted? Remember, we started off with $3 of extrinsic. So people assume if we have no time that has passed and we're just pumping up intrinsic value, that this $3 should stay. And that's kind of the illusion here. It's actually falling. Even though time hasn't passed, volatility hasn't changed, it's falling. We're going to find out why in a second. But this is really what's causing the option to appear to not move dollar for dollar.
Now, let's do a fun little exercise here. Let's suppose that on the right side of the fourth column, we had a column called $100 put.
Ooh, I know where you're going with this.
Extrinsic value. So let's make a couple of assumptions. One, the stock is 100, like the chart says, and number two, the interest rate is 0.
Okay.
Right? Just to simplify
makes it easy. Yep.
The dynamic here, right? Because there's no cost of carry, there's no forward carry, there's none of that. So if we have a $3, if we have an at the money option, call option that's $3, then if it truly is, which it is kind of a 50-50 shot, what should the extrinsic value or what should the value? That's not going to be in the money either, right? It's just going to be at the money. That's got to be
$3.
$3, right? It's got to be $3. So now let's just jump it to the next one, right? 255 is the extrinsic value on the call. Sorry, 255 is the extrinsic value on the call for a total of 355, which is 255 plus 1. So what's the extrinsic value on the put? Now think about what's happening to the put. Just think about it intuitively. What's happening to the put price as the stock is rising?
Good. Yep. Put's going out of the money.
Right? Oh my God, I own this put. I paid $3 for it. Oh crap, the stock's going up. It's going down in value. It's all out of the money, right? It was out of the money to begin with. It's now further out of the money. Remember, the strike price doesn't change. The stock price is changing around the strike price. It's becoming further out of the money. What's happening to the price of the option? It's going down. So what would be the price of the value of the option, or the extrinsic value, which is 100% of the price of the option at 101? 255.
Yep.
Right. It's a synthetic version of it. Same thing with the 102, 214. Same thing with the 103, 178. Your put value would be 178 with the stock at 103.
Yep.
Right. It's just a synthetic version of it. So, when you guys are thinking about rolling or doing, something like that, think about the synthetic side of it. Oh, I'm rolling a call up. What are you paying for the put? What are you paying for the put spread? Right. You got a $10 spread that you're trying to get $8.50 for. You're paying $1.50.
Paying $1.50, right?
For the put spread. Right. You got to think about it. We start thinking about it from the synthetic side of things. Really makes things a lot clearer about where these prices are coming from.
Okay, so just to be clear here, when I put the market maker to the test, Stu, we're going to keep the same assumptions you did. We're looking at our quote board here. Now over to the right are the puts. We can't see them here. What is the 102 put trading for?
214.
214. How did he know that? Because it's the same. A call's a put, put's a call. Now here's another question. Well, if the option is worth 214 for the insurance value, why is this one trading for 414? Why is it $2 higher?
because I have a right to pay 100 for an asset that's trading at 102.
102, right. He's got $2 of intrinsic. So yes, the call option is going to have $2 of intrinsic that the put does not have. Now, what if we went the other direction? What if we went to the 95? All right, we could also say if we kind of pick this up, we could reverse that. We would have $1 worth of intrinsic on the put, and whatever the extrinsic value is on the call, we would just tack it onto $1 and we would know the price of the put.
Right. You know, it's going to, if the stock's 95, you know, there's going to be $5 of intrinsic value.
Yep.
Right. And then go from there.
Yep. Go from there. So now we can see if we just want to look at the options price, stock goes from 100 to 101. We go, man, it only picked up 55 cents. I got ripped off, Stu. The stock went up $1. How come I only went up 55 cents? Well, again, it depends on how you look at it. You did pick up $1 of intrinsic value. What happened is you lost 45 cents on your insurance policy. All right, so that's what's happening. It's this insurance policy is starting to
And by the way, everyone, this is not decay.
That is exactly, well, again, it kind of is it. That's not, when we talk about decay, it's usually the passage of time.
Right.
This is something different. And we're going to talk about. It's a good point.
Yeah.
Because we held time constant. This is not from the passage of time, but yet the option or the extrinsic value is decaying, or at least so it appears. That's part of the things that throw people when they're looking at strategies.
So you might even say, let's say this call has a 10-cent theta. And you might say, well, let's see, I want to remember the stock's 100. You might say, well, if the stock goes to 103, I got an extrinsic value of 178. My put's going to be 178. But over the passage of, say, 7 days on a 10-cent theta, that's going to be 70 cents off of that, or 108.
Yeah.
So you could say, oh, the put's going to be 108, right? And now you know, right?
Yeah.
Without having to wait for the rip-off market makers to give you your price. You kind of know ahead of time what it's going to be.
Right.
So again, that's assuming a constant implied volatility.
Right. So the thing to notice is that these numbers here are declining even though time is not passing. Now, of course, in the real world, that's impossible. This is from a pricing model, but we're doing it to show a point that the option, the extrinsic value, will decay, or at least apparently decay, as the stock price moves. So why is that? That's kind of a weird concept to understand. So that's what we're going to take a look at here. So notice that we go back to our option right here, the expiration graph in black, the current in red. Let's put the stock at 110. We've got the right to pay 100. How much intrinsic value do we have, Stu?
I'm sorry, where's the stock?
Stock's at 110.
$10.
We got $10 of intrinsic, but notice that the option is trading for something more than 10 because we're not at expiration. This additional space between the black and the red is the extrinsic value. And that's why the red line moves towards the black, because that white space between them is the value of time. And so as time goes by, that red line starts shrinking towards the black. Let's say the stock is up here at 115. We've got 15 points of intrinsic. That's the distance from our zero line to the black line. We can see it lines up right there. Well, we paid 5, so we would have $10 a P&L chart. So we'd have $10 of gain. But how much additional option value is there? Well, it's there, but do you see how that arrow is smaller? That little white space is smaller than this one? The time value is shrinking. We go up here to a stock price of 120. We have $20 of intrinsic value. What else? The option's trading for more than 20, not much more. Got that little tiny slice in there.
Yeah. And look, eventually, maybe 130, 135, 140, I don't know, somewhere up there, these two lines are going to meet.
Yeah.
Even with remaining time. So if you go back to that chart, don't do it. Just, everybody just think about that chart we were talking about before with that put. It's like, oh, the stock's 140. The puts are no bid.
Yeah, of course not. Nobody wants them.
which means the call option is a parity option. It's trading for the intrinsic value. There's no extrinsic, but hey, I got a month left or 2 weeks left or a week left. Well, you could really see, it is like Bill said, it's a little bit of a play on words. Is there time value left? Yes. What is the time value? Nothing. Right? It has time, but the value of that time at that point would be zero.
At that point,
so
right.
These two lines will merge at some point. So this extrinsic value that we're talking about that's going down in value as the stock, as the option is picking up intrinsic value, they will eventually meet to the upside.
Yes, they will.
And that's
important. And to the downside as well. Yep.
And well, they'll both go to zero.
Yep, that's right. So now what we want to explore here is why. Why is this option, extrinsic value, what we call the insurance value, declining? Well, remember that the extrinsic value is what you're paying for the right to walk away. That's the key. If you ever get stuck in trying to figure out why that's happening, just tell yourself that the extrinsic value is the price you're paying for the insurance. What's the insurance in it? Well, it's the right to walk away. So you don't have that for shares of stock.
That's a little weird for people to get because, everything that anybody ever reads is it's the right to buy the stock.
Right to buy the stock, yeah.
What it really is, when you dig deep into it, is exactly what Bill just said.
It's the insurance value.
To just walk away from it. Right?
Yep.
If you buy the 100 call and you pay whatever, you pay $3 for it. Well, you don't have to buy the stock at 100 or 95 or 90 or 80.
No.
You don't have to do any of that. You can just
as a stock owner, and you bought it at 100, you own it at 80. There's nothing you can do about it, right?
You own it at wherever it is.
Yep.
But if you own the option, you have the right to say, I'm out. I'm out. It's okay.
So the thing to understand is that options provide insurance, and that is true whether it's a call or a put. That's important. And insurance has value when there is uncertainty. That's another key. Insurance really has no value if we know that something's going to happen.
Right. Would you pay anything for the, let's do a quick exercise. Would you pay anything for the synthetic put? That's the extrinsic value on the call. If you knew, which we don't, but let's just play a game. If you knew the stock was going higher, for sure. Right. Yeah. The insurance would have no value. There wouldn't be any extrinsic value. It'd be a parity call and the book would be zero.
So the point here is that the more uncertainty that there is in the market, the larger the premium. So as the option moves in the money or out of the money, the insurance value decreases. Why? Because the uncertainty is falling. That's the key. We could also say that the confidence is increasing.
You're either further in the money or further away from it.
That's right. So for instance, let's go back to our bell curve. We've seen this guy here before. Remember that for every stock price, we have an implied bell curve sitting over the current stock price. This area in blue is a 1 standard deviation move. About 68% of your data will lie in that region, about 95% within 2 standard deviations, and almost all of your data fall within 3.
Almost is the key word there.
Almost, yeah. There's a 4th and a 5th and a 6th, and they just keep on running, but they are so small out there. It's just not even worth talking about.
But again, it doesn't mean it can't happen, right, Bill?
Doesn't mean it can't happen, but we have to look at the probabilities. That's how they're pricing the insurance.
Yes.
So now let's go back to our 100 call expiration graph in black. Oh, here's a good picture. You can see where they've actually converged to. I've zoomed out on it. And we have, actually, I think maybe I've just done it with more time going by, but you can see that the red line, we still have a little bit of extrinsic value, but the bell curve is sitting where? Right over the current stock price, right at the bend. All right, so is that option going to be in the money or out of the money at expiration? 50-50 shot.
I don't know.
And that's why you're going to pay the most extrinsic value, because at the money options are a 50-50 shot, basically. We don't know. We have maximum uncertainty, and so the market says, you know what? I'll give you a lot for the insurance policy.
Bill, if you can figure out the answer to that ahead of time, can you let me know?
Absolutely not.
And I kind of say that in jest because that's what people ask a lot. Should I
Oh,
get
they all do, yeah.
should I get out? Is this a good place to buy?
Right.
Well, how should I do this? What should I do with this option? I'm up some stupid number of percent, or I bought it at 4 and now it's at 8. Should I get out? I don't know.
Right.
I have no idea what you should do. There's adjustments that you can make, but you got to stop thinking about like where's the best place to get out.
Yeah.
Nobody knows what the stock is going to do in the future.
Right.
That's going to determine it. What's the stock going to do, and how long is it going to take to do it? And what's the dividend, and what's the interest rate, and all that kind of stuff factors into your decision making process. But the problem is you have no idea what the stock is going to do.
Yeah. So that's really what the bell curve is showing us here. The width is showing us the uncertainty or the standard deviation, or in stock terms, the volatility. So now let's say that the stock moves up. Where is the stock trading now? Center of the bell curve. Let's say it's trading at 110.
Okay.
What do you notice about what's happening out here? Remember, we have the 100 strike. Now ask yourself, what's the probability for the option to land on this left tail, or for the stock price to land on this left tail?
Less than it was before.
So how much are you going to pay for the right to walk away when you know that you're probably not going to be walking away, given that the stock is 110?
So here's the answer. Ready?
Not much.
Less.
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 You're not willing to pay as much as when the stock was at 100. What happens if we push the stock price even higher? So anyway, the point there is that you are fairly, not 100% confident, but you're fairly confident that you won't be walking away from the deal if the stock is 110. Let's push the stock up here maybe to 125. Now, by the way, I've drawn this. Look at where that tail is. The stock is down here. What's the probability for that, according to this picture, probability for that option to go out of the money? No chance.
Less.
So
again.
Certainly less, but the pricing model is going to price it at 0 because there's no chance for it to fall out of the money.
It might. It might.
Yeah. Well, I understand, but I'm just saying if you push that enough,
if you push
the pricing model is just looking. The pricing model can't take future news into account.
Right.
The pricing model will eventually hit a point that says that 100 call is 0.
We can fool with the pricing model and slip in.
Understood. I'm just trying to make the point that when the bell curve, the left tail right here, isn't over that bend, there's no chance. So the extrinsic value goes to 0. So now we are highly confident that you or somebody else isn't going to be walking away. We are saying that we are highly confident this will become shares of stock.
And that doesn't mean we're going to take shares of stock. It doesn't mean we're going to take the exercise and receive the shares of stock. We could just sell them.
Of course. But we know that the delta is going to be 1 because there's no extrinsic value to detract from that.
Yeah.
All right, now let's move in the other direction. What if the stock is down here somewhere, let's say maybe at 95? Now look at where the bend is. Now what's the probability for the option to go out of the money or in the money?
Well, if the stock's 95, we're talking about the 100 call. It is out of the money at this point, everyone. So do we have less extrinsic value? First of all, we have no intrinsic value because it's out of the money, right? And we have look at it like, the stock's got to move 5 points just to kind of get back to even.
Yeah. So you're saying, okay, well, how much would you pay for the right to walk away from this deal? Well, you're probably looking at this going, you know what, I'm fairly confident, not 100%, but I'm fairly confident I'm going to be walking away from this deal. So if I have confidence in what the outcome is going to be, why would I pay you or somebody a lot of money for the right to walk away?
Why would I be paying that? And that's code for extrinsic value. Why would I be paying a bunch
You're just not
value if it's
it's telling us
like it's going to be any use to me?
Right. The extrinsic value is what? Less. It's going to shrink. Yes. What if the stock is way out here?
Yes. Right.
Now we're saying, all right, the chances according to this bell curve for the stock to be out here is basically 0. The option's virtually worthless. Stock is down here at 85. Our bend is up here. We can see that bell curve doesn't even cross it, or maybe ever so slightly, but it's going to be
And what
worth
we're
pennies.
saying here, everyone, is that the call option, and we all own them. We've all owned them, and we will all continue to own them. Is going towards zero.
Yeah. And that's because the key is that we are highly confident that you will be walking away. But when the bell curve was over here, we were highly confident that we won't be walking away. And with the bell curve over here to the left, at least for a call option, we're highly confident that you will be. But both extremes have confidence. And because we are on the confident side of the scale, the insurance policies go down, extrinsic value. So, but when we go right here, I have no idea. It is the maximum uncertainty, and that's why your extrinsic value is going to be so high. So when that stock makes that first move, yeah, you're going to start losing some extrinsic value in there. It's going to appear that you didn't pick up $1, but
Yeah.
you did. You picked up $1 of intrinsic, but you also lost some extrinsic value.
Yeah, look, this is a basic, options 101 pricing theory. Extrinsic value is highest at the money, period. Right? And if that is true, which it is, as you move away in either direction, it's less.
Yep. So the point here is that you have no idea whatsoever whether you're going to be walking away when it's at the money. Now, what happens if volatility, we're going to do a couple quick ones here, volatility changes. And before we do that, quick reminder, marketrebellion.com/get started. So what if volatility changes? What we're trying to show you is like a little model to put in your head to figure out why things are going to change the way that they are. Let's go back to our stock up here at 110. And now let's say that volatility has increased. We're saying, I'm pretty sure this is going to be in the money. I'm not going to pay a lot for the right to walk away because that left tail, not a lot of area out there. But what happens if volatility rises or just the perception of it? We're coming into an earnings report. What happens to our bell curve? It gets shorter and wider. We have more possibilities. So it's going to do this. What happens to the value of the insurance now? Now you're saying, there's a really good chance it's not 50-50, but it's not negligible either.
The range got bigger.
Range got bigger. So yes, your insurance policy got much bigger. Now, what happens if we go the other direction after earnings, what we call the volatility crush? And we do something like this. Now what happened to your insurance policy?
It loses out.
Just completely, you might have said, hey, it was worth $8 of extrinsic value. The stock hardly moved, and I lost it all. Well, that's because the market now says there's no uncertainty. The cat's out of the bag. We know that what the results are. We're not willing to pay the insurance anymore.
Or how about this? You paid $8 for the option. The stock, you paid $8 for the call. On an out of the money call, you paid 35 on a 35 delta call. The stock is up. I'll just leave it at that. The stock is up, but my $8 call is trading at $4.
How did that happen?
Whoops.
Right? You did pick up dollar for dollar on that stock move, but your extrinsic value lost a bunch. And that's where people go, well, how could it lose a bunch? It was only one day that it moved. Yeah, but it's the bell curve here. It's the implied volatility that's collapsing, and people are just saying, I'm not willing to pay that much for the insurance. And now you've got a good visual to understand why. So anyway, back to our question now. Hopefully that's a good little option theory tour, kind of help you to understand why the extrinsic value decay or even appears to decay just as the stock price moves. So does a call option gain dollar for dollar as the stock price rises? How would you answer that, Stu?
Maybe. Well, the real answer is no, but you got to break down the value, the price of the option.
That's right.
And it's extrinsic. And
That's
that's
right.
what we're after. We're after everybody to just kind of think about where that price is coming from. No, it's not coming from some,
Right.
blank market maker that's making up a price somewhere. It's coming from a place, right? And if it's out of the money, it's all extrinsic value, no intrinsic. If it's at the money, it's all extrinsic value, no intrinsic. If it's in the money, it's intrinsic and probably most likely some extrinsic, and those numbers change.
Yep.
Right? Those numbers. The stock moves up $1 with an in the money option. It's picking up $1 of intrinsic value. But as Bill showed, 20 different ways, that the extrinsic value is.
Extrinsic value is really what's being
You might pick up a dollar,
what's
30
subtracting
cents,
from it.
you have an
So if you
option.
yeah, I was going to say, so if you understand those dynamics between the intrinsic and extrinsic, it will help you to understand how certain strategies are going to converge towards maximum value or how they will diverge.
Calendars, butterfly.
Calendars, butter, exactly, when you've got time in
diagonals.
there, because people just get thoroughly confused. But even if you're doing something like stock replacement, why is it not moving dollar for dollar when it's so deep in the money? Well, it's not deep enough in the money to where the market doesn't feel like it's totally impossible for it to fall out of the money. There's still a little insurance policy on it, and that's going to start becoming less and less as that stock moves or as time passes. You need to understand that.
Absolutely.
So anyway, we hope that gives you some good things to think about for all of our market rebels. You can we're actually talking about volatility this week, right? We're going to do volatility part 2 and Q&A tomorrow.
There you go.
So please join us for that if you can, and if you're out there in YouTube land and would like to take your options trading to a higher level, you can do that. Please give us a call there. Talk to one of the sales reps. You can get it and jump into our Q&A classes. These are the type of topics that we talk about every single week. And so with that, we hope you picked up some good information, and we will see you next Thursday on Coach's Corner, 4 p.m. Eastern. We'll see you then.
Adios.